Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and watching the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And we'll welcome Dimitri into the show. How are you doing, Dima?
Good morning, Will. How are you?
Morning. So what are we looking at today? Theoretical value, models.
Yes, so today we're going to cover, hold on a second, let me just share my screen here. Tell me if you could see my screen.
Yep, I'm adding it to the stage now.
Okay. Yeah, today we'll cover the significance of theoretical values, what they are, why traders use theoretical values to help them with their decision making. And we'll go over some examples of what that means. So let's do that by choosing a stock for our example, and I'm just going to default to SPY. So let's just go to SPY here. And we're going to look at some options theoretical values. So let's go here under options chain. And I'm going to first expand options chain. Hold on 1 second. Let me close this menu on the side to expand our view of the options chain. And let's just come out maybe to a different expiration. I'm going to slide down here. And now we're looking at this options chain. And we have all these bids and offers, right, for each individual option. So you can see here we have calls on the left-hand side, puts on the right-hand side. We have these strikes, and then we have these bids and offers for each option. So when you're looking at, this options chain, question becomes, what are these options worth? And I could hear in the background you're typing.
Oh, sorry.
Yeah. So when you're looking at these options, one question is, what are these options worth? Are they on the high end or on the low end? Because you're just looking at prices. And as traders, we try to benchmark these prices versus a theoretical value or some type of a value, so we could compare the market prices to a theoretical value. And it's very common to run financial models to create a value for something that you're trading. So when we try to create this value, there are, and think of it this, just to give you an idea, when you're going out there, let's say, and you make an investment and you need to borrow money, right? Like a real estate investment. Well, if you need to borrow money, what the bank will do is appraise that investment. They'll appraise that piece of real estate. They'll come up with a value to make sure that wherever you're purchasing it's either the price you're paying is a fair market value or below, because they want to make sure protect their investment when they're giving you a mortgage. And it doesn't matter if you're borrowing for business or a real estate. Whenever somebody when somebody lends you money and their collateral, they put a value on it. So similarly, when you're making investment decision, you want to try to put some kind of value on it to see how far away the market prices are from that theoretical value. And when we create a theoretical value. There's no real one way in options to do that, because it depends on the model you choose to use and the data that you choose to apply to it. So there's no right value. It's kind of like a benchmark that you're creating to see how far away the market prices are, and then justifying if the market prices are at a premium or a discount, if that is justified. So also to give you an example, you could look at a value of a company or a piece of real estate, and there are different ways to try to analyze. You could look at a part of cash flow, how much what's the cap rate of the rent versus the purchase price, or you could look at it as what is the value of this piece of property based on what similar property sold for, or you could place a value on it on what if I had to build a similar property, buying similar land and building similar property. So there are different ways to approach it. So there's no one right model. It's just there are models there that help you try to assess that value. And to make it in options easier, because there's so many different options available here, right? We try to come up with a theoretical value, which is right here in between. So these here are theoretical value columns, right? And in between the put bids and offers, and in between the call bids and offers, to help us get a sense of how far away these bids and offers are from our benchmark theoretical value. So when we, by default over here, right now, we have it set to, so here are the theoretical values you could run. And by default, we have this called best fit implied volatility curve. And what this will do is look at the implied volatility structure within the expiration and use the binomial model. So it's an options pricing model. And it'll say, okay, if we started out with the at the monies, which the at the monies are usually the most liquid options, right? If we start out with at the monies and create a volatility smile, a best fit volatility smile through the different implied volatilities in each strike, what would that look like, and how does that compare to the market prices? And the idea there is to smooth out that curve, to spot if there's any strikes or something unusual that we could spot. Okay, so that it'll kind of like stick out a little bit better when things are jagged. So this is a best fit line or best fit curve. And a couple of things also that the Black-Scholes model or binomial model helps to spot is when there is a cost of carry, when the options based on their cost of carry are kind of a little bit out of line. And they could be due to several factors. It could be options or stocks that are hard to borrow. It could be, where there's a dividend and it's hard to forecast that dividend. Maybe the interest rate assumption is different. So there's a cost of carry component in the options. And in a quick way to spot that is by running your options pricing model, putting in your assumptions and comparing it to the markets. So for example, here we see that these puts You see them in the red, which means that our theoretical values are either right on the bid or a little bit below. Okay, so when those cross, it lights up red. So you could see here the theoretical value is $9.26 with this option $9.28. In the green, that's when the theoretical value is a little bit above the ask price. So the theo is higher, because we have this range, right? In the market range, the theo is higher. Outside the range, if it's lower, it lights up red. If it's green, if it's higher, it lights up green. And this is saying that whatever the assumption in our interest rate is a little bit higher than the market is suggesting. So when a lot of them are green in the calls, red in the puts, that means it's most likely, our interest rates are a little bit higher than what the market now is pricing. And that could fluctuate throughout the day as well. So we kind of peg it to where we see the, starting from the Fed funds moving out to the treasuries, we create our, interest rate structure, interest rate terms. So when you look at the interest rates, you'll see, you'll see 3-month bill, 1-month bill, 1 year, 2 year. So we create a structure from there. So the interest rates can fluctuate a little bit as well. So this is one reason, that's something like this could show up. I'll show you a different way where the Black-Scholes model will show up where it's a hard to borrow situation. So let's say we have a report here under options, under screeners. It's called synthetic long stock discounts. So these are situations where the options are lined up, indicating that that the stock itself is hard to borrow, and because of that, that's reflected in the cost of carry component in the options. So let's look at, what is this BITX? So BITX, this is an ETF, 2x Bitcoin strategy ETF. Okay. Looking at this, because this is a little bit higher stock price, these are like dollar stock price, but here's a BITX. And actually, let's look at a large discount. So I'm gonna sort this by the largest discounts. So here it's saying this particular stock, PARA. If you click on this little info sheet, it'll tell you what the stock is, and you could read about it, what it does. And this is telling us the following, that the stock price is $11.70. If we use the options, right, and we use the options and we look at the option pricing model, and we look at the put call parity. So there's a thing called put call parity where it says the put and the call, could be assembled to create a synthetic stock. And if we look at that, the options markets are implying that there's a discount in the options market to create a synthetic stock. So the synthetic stock for this expiration, July 18th, is $9.95, which is almost a 15% discount to where the spot price is. Okay. And here you'll see the synthetic bid is $9.01. Synthetic ask $9.95. So it's a wide market, but it's in July 18th expiration, 124 days to go. And that indicates that there's a large demand to short the stock, but there's not enough available stock. And what happens is, if there's not enough available stock to borrow, because to short the stock, you got to borrow it. And to borrow the stock, you have to pay somebody to rent their stock, right? Well, I'm gonna use your stock, because I want to short it. You got to go find it, locate it from somebody who owns it, willing to lend it to you for a fee. This is done by the brokerage firms, and then they borrow it and sell it short, and then pay the fee. Well, if there's a high demand to borrow, then the fee goes up. Okay, that's a competition, right? The fee goes up. So think of it like, if there's a high demand to rent your house, your property, then the rent goes up. So this is what's happening here. And when that borrow rate goes up, it'll get reflected also in the options market, because you could short it too. You could go and borrow the stock and short it, or if it's not available, you could go to the options market and short the stock. So that those two markets, right? Those two markets will adjust to that supply and demand. So here we see that our theoretical model says if it wasn't hard to borrow, right, then we should see the put call parity match up with the stock price, but it doesn't, right? There's it's at a discount, 15%. So that's quickly using a model just to point that out. We could see what the discount is, and it's wide. So let's go to this option. I'm going to go to PARA. Okay. There is something going on here, so it seems like might be a takeover target, but I'm not going to go through the news. I'm just going to show what that looks like. So we were looking at July, I think, over here. The July options. Let me see if actually these. Let me go back and see which ones we were looking at. Right, July 18th. So let's go back to the July 18th. Oops. So here, actually, this wouldn't right now. As you can see, the options actually went very wide at the end of the day. Let me see if I could come. Let's go. So you could see here they're $1 to 5.50. So that's a very just this put. Let me just go back like maybe at 3 o'clock. What that look like? All right. These markets are wide. Let's look at something that's a little bit more narrow. I think this just is not a good example because the markets themselves are wide. You can see the 12 put, it's 10 cents bid offered at $4.55. So I don't think that's a good example to look at. Let's pick a different one. So I'm going to go back to the synthetic long discount. Take a look at see if I could find a market that's a little bit. All right, let's see if we could look at this one, LAZR. All right, there's the LAZR, the stock's 550. The synthetic is telling us it's 460. So let's see if these markets are a little bit tighter. So we're looking at LAZR August. Okay, so over here, we could see that that, let's take a look at the 7 strike. So you can see here that our calls, right, the call options, our theoretical value is 82 cents with the market's 52 cents 60 cents, while the puts, the theoretical value input is $2.68 with the puts $3 bid at 3.15. So let's line that up. So if you're buying a call for 60 cents on the 7 strike, right, and if the stock went up, let's say to, whatever, $10, well, you would end up buying the stock at the strike price of $7 plus 60 cents, right? So that would be $7.60. And let's say you sold the put at $3. So if the stock went down, you'd buy up the stock at $7. If it went down, plus you received $3 for it, so it's like $4, right? So look what that would look like. So over here, your current price, right? The synthetic price is right here, right? Sorry, it's right here, like let's say 465, right? But the spot price is 505, so you're buying it like in a synthetic discount. Okay, so think of it as $7 minus 3, 4 plus 60 cents, 460, right? With the stock price at 505, so you can see there it's a 45-cent discount, right? Because you bought the call, sold the put. So no matter the stock goes up, you're exercising the call. If the stock goes down, you're going to get put on the stock. So if you received $3 and paid 60 cents, right, on the 7 strike, it's like at 460, right? So synthetic. So this is where the model is showing us that, hey, something's out of line. The put call parity isn't holding because, it should be 505 plus whatever interest you would receive. Because when you short a stock, you're receiving interest, usually, right? So here you're paying out more than you're receiving. So this, is one way that we're using a theoretical model just to point something out, that the markets here are indicating something that is unusual, or there's a cost of carry component here that's out of line, needs to be looked at. So in this situation, whatever LAZR is, it appears there's a higher demand to short the stock than there is stock available to be loaned out. All right, so that's just a quick example of using theoretical pricing model for a trader to quickly point that out. You could just using these, it would just stick out. Now, you would think, well, I could create an arbitrage, but in reality, right, what this is saying is you can't, because, or most likely you can't, because even if you're buying it at 460, right, the synthetic, to create that arbitrage, you would have to be able to short it at 505. But there's no stock available to short, meaning that most likely, it's either not available to short, or the fee to short it would equal whatever we're seeing in the options market or more. So this is probably the case what's going on. Okay. Of course, if you're able to borrow it from somebody without paying the fee, then you would be able to create that arbitrage. So, well, I'm going to stop right there because I just wanted to kind of point out one way traders could use theoretical models to spot things in the market.
That was great, D. Thanks for bringing that to the Chameleon community. Another great morning webinar. Everyone have a safe trading day. Enjoy the start of the week and St. Patrick's Day today. Great job, D, as always, my friend.
Thanks, everyone. Stay safe out there. Have a great trading day, and hope to see you tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye.